Hello class, this is Dr. Fenton. In Chapter 6 we talk about inventory and cost of goods sold. This chapter is quite detailed. We have several inventory methods we have to go through. They can be a little bit confusing, so please pay attention. Please review the video again if you need to. And as always, please read the chapter and follow the examples very closely. Let's get started. First, let's look at what we're building to in this chapter, and this is something called a multi-step income statement. Now, what we'll do here is have various steps, various subtotals throughout the income statement. The first one you come to is gross profit. And to compute gross profit, we have net sales, and then we will subtract cost of goods sold. And that, of course, gives us gross profit. Now, net sales will be a dollar amount net of returns, allowances, and discounts. And these are where the customers have sent us merchandise back, we've allowed for a reduction in price, and we've given them a discount if they paid early. We subtract those three things away to come up with net sales. Cost of goods sold is something explained more in this chapter later on, and this represents the cost of the inventory that we sold. So you can see net sales is a little over $40,000. And the cost of goods sold is a little over $31,000. And of course, as always, you want to be able to sell your merchandise for more than it cost you. So we have a gross profit of a little more than $9,000. The next section will be operating expenses. The examples we're going to see in the textbook and probably in your quizzes and exam, you will have all these various expenses listed separately. So you have selling expenses, like marketing and so forth. General expenses, just for running the company, and administrative expenses. This will be advertising, salaries, utilities, supplies, depreciation, other expenses like insurance, and so forth. So once you have all those, add those up and get the total. So your total operating expenses, in this case $7,597. Subtract that from gross profit to get operating income. So operating income is the next important step we see in the multi-step income statement. Other income or expenses are items that are not related to the everyday operations of the business. So if you have some type of investment that you have in the business, maybe you purchase stock or bonds or whatever, and then you decide to sell those. Again, this is not part of your regular business. Then you'll have a gain or a loss on the sale of that investment. So you put that in this section. So here we have a positive $13,000 gain. Investment income, maybe we're earning dividends or interest on other investments we have. Positive $14,000. Interest expense is shown down here under other income or expenses. A lot of people tend to put interest expense up in the operating expense area, but it doesn't go there. So interest expense needs to go down under other income or expenses. We subtract those from operating income, and we get a new step, a new subtotal called income before income taxes. Then we take away income tax expense, and this gives us finally net income. So this multi-step income statement is more complex than the simple ones we've seen so far. So far you have maybe just like service revenue and take away some expenses and then get net income. In this one we have multi-steps that need to be shown in the income statement. So these steps again are gross profit, operating income, income before taxes, and then net income. Let's turn to inventory. Now, inventory, as I'm sure you know, represents the items a company intends to sell to customers. These are listed as a current asset in the balance sheet. Cost of goods sold represents the cost of the inventory that is sold during the period. It's reported in the income statement as an expense. So inventory is the cost of the items that you're going to sell to customers, and it's a current asset. Cost of goods sold is the cost of the inventory items you sold during the accounting period. Let's see how these sort of tie together. When you start a new year, you have inventory left over from last year. So that's your beginning inventory item. It's an asset. You purchase more inventory during the year. That's also recorded as an asset. And so the total of those represents an item called total inventory available for sale. Sometimes this is called cost of goods available for sale. Either way, it's the total of the beginning inventory you had to start the accounting period off and the purchases you had during the accounting period. At the end of the year, the cost of the items you did not sell, This is your ending inventory. And so in this case, let's say we had $30,000 of inventory we did not sell as of the end of the year. But that means the other part of the $110,000 is the cost of the inventory we did sell, and so that's labeled as cost of goods sold. So let's go back to the beginning. Your cost of inventory you had before the year started, $20,000. You purchased 90. That totals to 110. Now the 110 has to go somewhere. You know, as accountants, we have to account for every penny. So that has to go someplace. And so it's ending up in either ending inventory on the left or cost of goods sold on the right. So those two must total. In other words, the $30,000 in ending inventory and the $80,000 in cost of goods sold must total the total inventory available for sale amount of $110,000. Now, inventory costing methods. We have 4 we're going to discuss on this slide. The middle 2 are the ones you really need to worry about. This first one is called the specific identification method. What this does is matches each unit of inventory with its actual cost and record that cost into the cost of goods sold account. For example, let's say that you had a car dealership, and as you try to sell a car, you know, you're dealing with the customer, trying to make a deal, you know exactly how much that car cost you, your company. You know the model, you know the options on it, so you know how much it cost you. And then you bargain for the best price you can get. Once it's sold, you will record that car's cost into the cost of goods sold amount, and you'll take it out of the inventory account. Now the first in, first out method and the others get into a situation where you're not worried about accounting for each individual item as you sell it. Let's say you have another store, another kind of business where you're selling multiple items that cost the exact same thing. So you don't want to record for every little transaction the cost of goods sold for that one unit. So the first in, first out allows us to do this as a group. The assumption here, as you can see, is the first ones that you purchased, the first inventory units that you purchased, are the first ones that you sell. This is typically the case. So you might wonder, well, what's the difference here? Why do you assume this? Well, that's because we have another method we can use, if you want to, called last in, first out. This method assumes the last inventory units that you purchased were the first ones that you sold. We're going to see the numbers in a minute why this makes a difference, but you have your choice. You can use the first in, first out method that probably follows your inventory product flow more closely, or you can use the last in, first out method, and we're going to see in a few slides later, we're going to see that the reason people use this is because it lowers your income taxes. The fourth method is a weighted average cost. Don't worry about this. Here you just throw all the units into one big pile, take all the cost, divide by units, and use one cost per unit for everything that you sell. We're going to go through quite a few numbers in the next several slides. So here are the numbers we're going to start with. So try to pay attention to these numbers and come back to this slide if you need to. In our situation here, we have on January 1st, left over from last year, beginning inventory coming into this year of 100 units, and they cost $7 per unit. So the total is $700 on those 100 beginning inventory units. Then on April 25th, you purchased 300 more units that cost $9 per unit. So you can see the price is going up per unit. And that cost then, 300 units times $9 per unit is $2,700. Later on in the year, October 19th, you purchased another 600 units that cost $11. So the price keeps going up per unit. And 600 units times $11 per unit is $6,600. So what we have here is we have purchased during the year 900 plus the 100 we had at the beginning. So we have 1,000 units we're trying to sell during the period, 1,000 units. They have a total cost of $10,000. So we have 1,000 we tried to sell, total cost $10,000. But depending on when we purchased these units and the ones we had left over last year, they have a different cost per unit in each of these categories, on each of these dates. So we need to keep up with that. Let's say, for example, all during the year we sold 800 units. So if we had 1,000 we were trying to sell, and we sold 800, that means we had 200 left over. So these will be the cost, or these will be the number of units we sold to the customers, and we need to find the cost of goods sold that attaches to this, the dollar amount that attaches to this. These are the units we had left over we did not sell by the end of the year, and we need to find the cost attached to that. Here we're going to go through the numbers using the FIFO method, the first in, first out, and yes, you do say FIFO, so first in, first out. If we assume the FIFO method, if we're using it, then we're looking for the cost of the 800 units that we sold. That means of the 800, we assume we sold these 100 first, then we sold these 300 out of the April 25th purchase, sold all those from the April 25th purchase. We are still looking for 400 more units, and so we assume we sold 400 of the October 19th units, and we still had 200 of those left over. So if you remember earlier on the previous slide, we purchased 600 units total on October 19th, and under the FIFO method, we sold 400 of those, and we had 200 left over. Now let's extend the numbers out, and so cost of goods sold will be the beginning inventory units. We sold all those. We sold all the April 25th units, cost $2,700. And then we sold 400 of the October 19th units that cost $11 each, or $4,400. That comes over here. So our total cost of goods sold is $7,800. Then we compute ending inventory. Now the ending inventory, you can see we had 200 of the October 19th units that we did not sell. They cost $11 each for a total of $2,200. Let's bring that across. And so the ones we did not sell cost $2,200 of those 200 units. And so there's your ending inventory cost of 2,200 units. So you can see here that the cost of goods sold of 7,800 plus the ending inventory units of 2,200 must equal the total cost of 10,000 units that we had right here. So 10,000 must equal the total of this number, and of course it does. Now under the last in first out method, or LIFO method, here we still account for 800 units as cost of goods sold and 200 as ending inventory. But under LIFO, we assume the last ones we purchased were the first ones we sold. Even if this is the actual case as a product flow, we still make this assumption. So we start down at the last purchase and work our way up until we find 800 units. So here we assume we sold all the 600. These are the last ones purchased. And so we assume we sold these first. They cost $11 each for $6,600. Then we're looking for 800 total. So we're looking for 200 out of the April 25th purchase. These units cost $9 each for $1,800. Then we're looking for the 200 we did not sell. They came out of the April 25th purchase, and we assume we did not sell the January 1st beginning inventory units. So let's bring the cost of goods sold numbers across. Bring these. These are 800 total. Here are the cost per unit, the dollar amounts. Bring those across. So under the last in first out method, our cost of goods sold figure is 8,400. That's more than the 7,800 we had a minute ago, and it makes sense because the later purchases cost more. And so we assume we sold the latest purchases first. Let's bring across the ending inventory units. So these 200 have a cost of $7 for 100 of those and $9 for the rest. And so 7 plus 9, 1,600. And now we have again the total of the cost of goods sold plus the ending inventory equaling $10,000. Let's go back up a slide. Here we go. Key point: any company can choose either method they want to use, even if it does not match the actual product flow. Why would you choose FIFO? Because it matches the physical flow for most companies. Ending inventory reflects the most current cost. It's called the balance sheet approach. Why would you choose the LIFO method? Well, this has in cost of goods sold the most current cost. It's called the income statement approach. There is also the LIFO conformity rule, which says if you decide to use LIFO for tax purposes, you must also use LIFO for financial accounting purposes. So taxes, of course, on your tax return, and financial accounting would be for the annual reports companies put out. Let's compare methods. Under the balance sheet, ending inventory, FIFO would be $2,200, reflecting the most current cost, LIFO only $1,600. In the income statement, if you sold these 800 units at $15 each, if you notice, whether you're looking at FIFO or LIFO, the selling amount is the same. So deciding which inventory method to use to account for your inventory cost does not have any impact on the amount you're selling it for to your customers. So no impact on sales revenue. Cost of goods sold, of course, is different. We saw these numbers earlier. Gross profit is also different then because we take away from sales the cost of goods sold. So under last in, first out, the gross profit's lower, and that would reflect a lower income before taxes and therefore a lower tax figure. The gross profit under FIFO is higher. Now, as we said earlier, FIFO more closely resembles the actual product flow of the company, of inventory. And then when costs are rising, FIFO results in higher reported inventory in the balance sheet and a higher reported income statement. Conversely, LIFO results in a lower reported inventory and net income amount, reducing the company's income tax obligation. All right, answer this question before I show you the answer. During a period of rising prices, which inventory cost flow assumption would result in the highest cost of goods sold and thereby the lowest net income? So which one? Highest cost of goods sold and therefore the lowest net income. In other words, which one saves you income taxes? Yes, LIFO. Another question. Which inventory method or cost flow assumption most closely resembles the actual physical flow of the goods? So which one probably most closely reflects the way you're actually buying and selling the physical product? The answer? First in, first out. There are two main inventory systems. These are not inventory methods to keep up with the cost per unit, whether you're talking about ending inventory, or cost of goods sold. These are systems. The perpetual inventory system, what you do here is in your inventory account, which of course is a current asset account, you maintain a record of the actual amount that you have. So as soon as you buy inventory, you record it as inventory in that account. When you sell inventory, you take it out of that account. Under the periodic system, you don't change the inventory account until the end of the accounting period. Then you make one entry to account for cost of goods sold and a reduction or increase in your inventory account. Don't worry about the periodic inventory system. We are going to concentrate with journal entries on the perpetual inventory system. Let's take a look at this. Some of these numbers look, again, similar. January 1st, you can see a beginning inventory. We have a purchase on April 25th, a July 17th sale, October 19th purchase, we saw that earlier, and then a December 15th sale. Let's record entries for, let's see, the first two items that happened during the year, the April 25th purchase and the July 17th sale. So April 25th, if you purchased 300 units that cost $9 each, you're going to debit the inventory account, thereby increasing it, and you're going to credit, since this is purchased on account, the accounts payable account. So accounts payable reflects the amount we owe to suppliers. So we're going to increase the inventory, it's an asset, and increase a liability, which is accounts payable. On July 17th, let's sell some inventory on account. We're selling it for $4,500. And so we're selling 300 units, and we're selling these at $15 each. Now we know they cost us less than this. We're going to sell them for more than this to make a profit because you have expenses to pay for, and we'd like to have a net income instead of a net loss in the income statement. Since we sell 300 at 15 on account, customers owe us $4,500. So let's debit accounts receivable $4,500. And this is a sale, so call it sales revenue, credit, and this is increasing the sales revenue account $4,500. Now to record the cost of the items, we're going to debit cost of goods sold. If you notice, these numbers in this second entry are different from the first numbers because we're selling these to our customers for $4,500, but these units only cost us $2,500. Now you can see that we debit cost of goods sold $2,500 and we credit ending inventory, inventory $2,500. Where we get this number is, remember, first in, first out, we assume we sold the 100 out of beginning inventory first at $7, and then 200 from the first purchase that cost $9. You add all this up and it's $2,500. So these units that cost us $2,500, we are selling them for $4,500. In the inventory account, if you went through the rest of the transactions, this is what you would see as activity in the inventory account. We had the beginning dollar amount. We had 2 purchases. That's on the left side. We had 2 sales, and so the $2,500, and then the cost of the December 15th sale will be $5,300. That's $7,800. Remember the $7,800 we saw earlier when we were computing the first in, first out method. And so the ending inventory balance at December 31st is $2,200. Other terms we have in this chapter will be freight in and freight out. Now, freight in represents cost of the shipments from suppliers. So if we have to pay for the transportation cost to get the inventory from the supplier's place of business to our place of business, that's called freight in, and the freight in charges are added to the inventory account. Freight out charges will be the cost of delivery to our customers. This shows up as delivery expense in the income statement. So make sure you know these terms, freight in and freight out. Purchase discounts. Discount offered by the seller to the buyer for a quick payment. So if our supplier says to us, if you pay me within 10 days, I'll give you a 2% discount. If we take advantage of that, that is a purchase discount, and we will lower the inventory amount by that amount. Purchase returns, of course, if we buy something and it's defective or no longer needed, we can return it to the supplier, then we will record this as a purchase return, and also we will lower the inventory balance. More terms. FOB shipping point. This tells legally when the title of the goods pass. So if the agreement is you're going to use FOB shipping point, if that's on the invoice, then the title of the inventory passes at the shipping point. So as soon as the seller sells this, then the title passes to the buyer even though the buyer hasn't received it yet. So the buyer owns the inventory during the shipment period. And of course the buyer needs to make sure it's insured in case it's destroyed in transit or whatever. Opposite of that is FOB destination. If this is the term you're working under, the title of the inventory does not pass to the buyer until it's delivered to the buyer. So whether you have FOB shipping point or FOB destination, you need to be working with the supplier and determine what is this. And it should be in the terms of the sale. It should be in the invoice. Here are some entries if you want to compare the purchaser to the seller. So on the left over here, if the purchaser buys inventory that costs $52,500, they're going to debit inventory and credit accounts payable if they're still going to pay for it later. The seller would record accounts receivable and sales revenue, and also record cost of goods sold for the seller that we're not worried about with this entry here. On a return, the purchaser would debit accounts payable to lower it. We no longer owe this money, and we lower inventory. We've returned this merchandise to the seller. We no longer have it, credit inventory. We no longer owe for it, debit accounts payable. The seller, on the other hand, when receiving this inventory, would debit this as sales returns and also credit accounts receivable. A discount, if the discount $50,000 that we owe, $52,500 minus $2,500, we still owe $50,000. If we pay within the discount period and get a $1,000 discount, then we debit inventory $50,000, credit inventory for $1,000, and then we credit cash for $49,000. So a purchase discount comes straight out of the inventory account. We don't have a separate purchase discount account set up. The seller would record this as cash coming in the door, 49, sales discounts. So if you're the seller and items are returned, yes, you do have a sales discount account. And of course, they would credit accounts receivable because they received the money and they are no longer owed this money anymore. So this is a comparison of the purchaser set of entries compared to the seller set of entries. Now, during the year when you buy inventory, sell inventory, so forth, then you record all that at cost. At the end of the year, what you will do is you'll know your cost of the inventory, and then you find out, has the price of that inventory gone down? Has the cost of the inventory gone down? Is it worth less than you paid for it? So at the end of the year, you make this determination. Which is lower for the unsold inventory? Your cost, what you paid for it, or what its replacement value is at this point, as of the last day of the year. If the cost is lower, there's no entry needs to be made. If it's worth less than you paid for it, you need to make an entry to reduce the inventory from cost down to what's called net realizable value. We're not going to get into these entries, don't worry about it, but this is something called lower of cost or market the companies use, and they need to show in the income statement, the balance sheet, need to show on the balance sheet the inventory at the lower of cost or market value that they're calling here net realizable value. Some ratios. This is a way to determine how efficient you are in getting your inventory out the door. So the inventory turnover ratio. To compute this, you will divide cost of goods sold by your average inventory. And the average inventory is a simple average. Just take the amount in your beginning inventory account, add that to the amount in your ending inventory balance, and divide by 2. So simple average, divide that into cost of goods sold to get inventory turnover. And that tells you how many times a year that you're buying and selling your inventory. Now, average days in inventory, this indicates the number of days usually that you hold inventory, on average. And so if you take the inventory turnover ratio amount you computed, put that in the denominator, divide that into 365 days for the year, you'll get the average number of days in inventory. So you'll know if you keep on average your inventory, 15 days, 20 days, 45 days. But it gives you an idea on how efficient you are in getting your inventory out the door. And if you think about this, a grocery store would have the tendency to have a very high turnover ratio and a very low number of average days in inventory. A grocery store needs to get the goods out the door before they spoil. A jewelry store, on the other hand, would have more than likely a very low inventory turnover ratio. They'll have the diamond rings and the necklaces and so forth in the shelves and probably will sit there for months and months and months before they're sold. So whether inventory ratio of high is high, low, good, bad, it depends on the type of business you're working with. There's also a gross profit ratio that you need to be familiar with. This is gross profit divided by net sales. You get both of these numbers from the income statement. So gross profit ratio is a very, very important number, and companies watch this very, very closely. What you see here is at the end of any one year, whatever ending inventory you have, it's gone through the numbers and help you compute cost of goods sold. The ending inventory number that you have equals the beginning inventory number, dollar amount, in the very next year. So these numbers will always be equal. So your December 31st, year one, dollar amount for ending inventory is your year two beginning inventory number. It's always the same. Also, look at this schedule. Make sure you know that schedule. You could be tested over it. So if I give you something like, what is beginning inventory, what are your purchases, what is your ending inventory amount, I would expect you to be able to compute cost of goods sold. Or really, if I gave you any of these three items, you should be able to compute the other one. So I might give you cost of goods sold, I might give you ending inventory, and then I might give you beginning inventory and ask what were purchases. So then you know if you have three of the four numbers, you can compute the other one. So make sure that you know this schedule right here. Okay, this is into chapter 6. Like I said, very detailed chapter. I know this is a long video, but go back and review it if you need to. Go back and please, reread your chapters, follow the examples through. All right, so good luck with your studies.